Happy Monday. It's Monday morning, and I have no idea what will have transpired between now when I shot this and when you're watching it, but there's certainly a lot going on, so let's talk about it. So, what started last week with a disappointing jobs report, maybe showing signs of weakness in the economy. We've got Iran potentially retaliating against Israel today or this week, and unrest in the UK. What's getting hit the hardest? Cyclical stocks, some of the more sensitive stocks like small caps, the NASDAQ certainly driving lower, and the Mag 7. So the Magnificent Seven, everyone knows the names by now. These companies are giving back potentially up to $1 trillion or more of market value between Friday and now Monday. What does that mean for us? So the Magnificent Seven, believe it or not, makes up 32% of the S&P 500. So there's 500 stocks in that index. These seven make up a third of it. And within our portfolio, believe it or not, those stocks only make up about 10% of our core equity model. So we've known these stocks are profitable, they're exciting to own, right? They're still our largest holdings, by the way. We just own a lot less of them than the market. We don't want that much exposure to these overly expensive companies because, predictably, when things go south, they're going to get hit the hardest if they're trading at those kind of multiples. By the way, if you look around, Bitcoin, Ethereum down 18 and 25% just this morning. So obviously we've got no exposure there. So, the good news is bonds are doing quite well, like they're supposed to. As interest rates have plummeted, that's good news for bonds. Our longer duration that we've taken on is certainly helping us out big time there. And, it's always good to just keep perspective. So we like to pull out this chart when we start to see these slides in the market. What does it tell us? Hey, if we look backwards at the S&P 500, the average largest intra-year decline in the market is 14.2%. So those red dots that you see, that's the biggest decline in the market during each of these calendar years. The gray bar is where the market finished up at. So year to date, the biggest slide we've seen is only 5%. This is what happens. I mean, this is what investing in the market means. We've enjoyed so much upside the last several years. This is what that risk feels like. And if the market just went straight up every year, that wouldn't have nearly the returns that it does have. And obviously, we're never going to recommend any kind of knee-jerk, reactionary type strategy when it comes to managing your portfolio. Let's just walk through some scenarios, what could happen. The easiest part of that decision is, call us and say, you know what, I really feel like I need to get out of equities, sit on the sideline, I'll just feel a lot better. And that might be true. And for you, that might be the right thing to do, right? If we're not sleeping at night, gosh, we gotta do what we need to do. But let's see, how's this gonna play out? So if we do slide into a recession, what does that mean? That means inflation is probably behind us. You're going to see the Fed cut rates more aggressively. Okay, the market's going to love these things. We could see the market go up even through a recession. It's happened before. But all of a sudden, when do you get back in? So let's look back. If you look back at that chart, by the way, 2020, the market dropped 34% that year. Do you know what it finished for the year? It finished up 16%. So what often happens is the market comes back a lot faster than the economy because the market's going to anticipate what's happening in the economy. The folks who during 2020 pulled out of the market, what percentage of them do you think got back in time to enjoy all the recovery and all the upside? It's a pretty low number, right? And if that happens today, okay, let's say the Dow's down to 39,000, 38,000. If you wait till you're comfortable and everything is settled, the market could be up to 42, 43,000. That's 4,000 or 5,000 points that you're never going to get back. And the compounding impact of a decision like that is something that you'll never recover from. So pulling out of the market is always half the decision. Let's just keep that in mind. And gosh, eye on the ball. Earnings reports are coming out. They're strong. We're still seeing earnings growth. Companies are still surprising on the upside. Companies are still profitable. And that's where your money is. That is what we're investing in. So, you know, if we do see a prolonged recession, that's going to open up planning opportunities. Does it make sense to hopefully refinance some of our debt, some of the new mortgages that are out? Maybe we do have an opportunity to harvest some losses. It will help you out on your taxes down the road. Maybe we could do a Roth conversion if IRAs are lower. You know, we've been through this before. Let's control what we can control and just keep our heads. So we are here for you. If you have any questions or thoughts, you know, we'd love to hear from you. You know where to find us. Thanks so much.